Hello, my friends. Brett Pattison coming at you from the financial capital of the West Salt Lake City, Utah. Joined by the big fella, the chairman.
Brett, good morning. How you doing?
Oh, living the dream, my friend. Living the dream. You want to know why I'm living the dream?
Why are you living the dream?
Because we're in the midst of a correction.
Okay.
And you know what corrections do?
Opportunities.
You nailed it, brother.
Yeah.
That's why I'm living the dream and many other reasons. In fact, let's give a correction update, because the contact that I've had with people as of late have been, hey, what do you think of the correction? So let's talk about what we think of the correction, and then talk about another very important principle to navigating the correction in the current environment that we find ourselves. So at the bottom, at least the bottom so far, the S&P 500 was down 12.5%. The Nasdaq was down 18.5%, and the Russell 2000 was down 23.3%. Now, folks at home, remember, anything past 10% is considered a correction. Anything past 20% is considered a bear market. That doesn't mean that a simple correction doesn't feel like a bear market, because I think that's why clients are reaching out, because they feel it's like a bear market. But
whether it's 9.5, 9.9, or 10%, it doesn't really matter.
Yeah.
It's just somebody decided that a 10% is a correction.
Is it official?
But if it
correction?
doesn't get to if it goes to 9.9, it's not official.
And then it's,
give me a break.
Did it close down 10, or was it just intraday? You know what? We're in a correction.
Let's just say that's stupid. Can I just say that? I just think that's all stupid.
You can, because it feels different. Half of the Nasdaq stocks were down 50% or more. So that particular index, which as a whole, the index was down 18.5%. Again, felt like a bear market, and for many still feels like a bear market. But as of today, where are we in as far as off of those lows, and where do we stand for the year? The S&P 500 is down 4.04%, so we've rallied back quite a bit. The S&P 500 has rallied back, the Nasdaq has rallied back 10%. It's down 8.5% right now. And the Russell 2000 has gone gangbuster. It's only down 6.38%, but it was down 23%. So we've seen a pretty good comeback in the market. We talked about in the last podcast about the correction, and that's what we thought it was. And I think a lot of us, and I'll say a lot of clients of ours and friends of ours, have been spoiled since March of 2020, because the market's gone one direction, and we haven't experienced a pullback to this, down 12.5 and down 18.5%. We haven't experienced that for a while, and so our recency bias is affecting what really is happening in the market.
Yeah, and I think a lot of people are assuming. I think the people are a little bit shell-shocked from March of 2020, and they think, okay, is this going to be something like that, where we're down 30+% over a short period of time? And that's painful for a lot of people. I would say that those kind of corrections are rare. We talked about how often that happens.
Once a decade.
Right, it's pretty rare. So I don't think people, just because the market's down 10% or 9 or 12 or something, that all of a sudden that's a reason to panic. Like, okay, this is we're just on our way down to 30%.
Yeah.
And you mentioned that there's a lot of companies in Nasdaq that are down 50% or more, and
those are the companies that what? Sucked?
Well, no, I mean, they should be down 50% or more. I mean,
from their highs, for sure.
Well, yeah, the valuations that investors were putting on those businesses with very little with profits, they didn't have a lot of profits. There was a lot of speculation, and there has been a lot of speculation in the market. And
the SPAC world.
Yeah, SPAC world.
Yeah, it's been decimated.
That's been flushed out, and that is actually healthy. I don't hope people understand that. I mean, I feel for anybody out there listening that was invested in those kind of companies, they made hopefully you're in it for a
They
while.
led the market last year.
Yeah, you
Now they're getting annihilated.
yeah, hopefully they, made money on those and didn't buy at the high. And unfortunately, I think a lot of people do. They kind of chase those kind of returns, and that's unfortunate.
But you said something interesting that we've said before, and let's reiterate. This is a healthy correction because it's flushing out all of that speculation.
I honestly, I just don't like it when that happens, when we have that sort of speculation going on. A lot of people just throwing money at the market, chasing trends and prices and things, and a lot of people had no idea what they're buying. They just knew that it was up yesterday and it's going to continue on, or it's going to go do that tomorrow. They're going to get out. They're going to make some money and get out. And that's just a lot of speculation. For me, that's like going down to Vegas and laying money on.
Yep. Black.
On black. You're right.
So here's the other thought too with that is, we heard from a few clients last year and a few friends, how good they were doing in their own investing because they were buying those types of companies. And then I've heard this, Brian, before we get into inflation.
Why weren't we doing that?
Why weren't we doing that?
Because why we weren't, I'll tell you why, is because what's happened the last couple of weeks and the last couple of months. I didn't want to go through that because I knew
we knew it was going to come.
I knew it was going to come.
But here's the response from them. But I put stop losses on all my trades.
Well, good for you.
Well, guess what happens? What happened with Netflix? It gapped down below everybody's stop loss and opened down over $100.
Yeah.
And then they get stopped out when the stock's down 20% plus. And then that's the very, very low. And then the stock goes, anyway, I'm going down
I hate stop losses.
I hate stop. They only stop you making money. That's what they do.
Yeah.
All right. Inflation's the big topic, right? Number came out today. We're at 7.48% inflation. The highest since you, my friend, were a junior in high school, you just said.
1981.
I like it. So that's a hot reading, right? What we've heard is we've listened to conference calls from a lot of technology names, from Maersk, which does a lot of the shipping and the ports and all that. They said that they are seeing things ease already, and by the second half of this year, we should see not normal, but we should see a significant improvement in our supply chain.
In fact, I think I just heard that expectations are peak inflation. I think second quarter this year, maybe this in a few more months. We should see peak inflation. So, I mean, who knows
Which who knows? I tend to believe that these companies on their earnings calls saying that's going to kind of moderate towards the second half of this year, but you never know.
Well, these are the guys in the front lines. And
yeah,
if anybody's going to know, it's going to be the people actually operating in businesses in this environment.
The two components to this that I want to talk about: inflation at 7.48%. I've had a few emails, and look, we could try to forecast energy and wages and what they're going to do and where inflation's going to be, but that's not known. Like, we'd be having a conversation about something we think, but we don't know. So based on an inflation rate at 7.48%, here's the more important reason, the more important discussion. How are we allocating portfolios to defend against 7.48 inflation, or 4% inflation, or 10% inflation? How are we allocating portfolios? Which is a conversation that I've had with many, or that quite a few people have asked me.
Right. So when we look at investing in a business, we're always looking for a business that has pricing power. We talk about businesses that have durable competitive advantages, including going through times like inflationary times like we're seeing right now. So some of our businesses that we own are directly benefiting from higher interest rates and higher inflation, directly benefiting. And we've seen, this year,
like what?
I mean, financials and industrials. Yeah. We own several of those in our portfolio. We also own some big technology companies, and they don't have, I mean, they're not really directly benefiting, but they have really strong economics, really strong economic power, pricing power, and are doing just fine in this inflationary environment. In fact, they, for the most part, are just doing extremely well.
We saw that in the earnings reports these
Right,
last 2 weeks.
Almost without, almost every one of them.
One company's struggled. The rest killed it.
But I don't think their struggles are necessarily inflationary
No.
reasons. It's other reasons.
Right.
So we feel very good about our portfolio and the companies we own, and going through this inflationary environment. By the way, the best asset to own in an inflationary environment is a great business. It's not owning bonds, especially long. If anybody out there has long duration or long.
Well, what's duration? What does that mean?
Yeah, duration is basically a long maturity, or it's a long time before that bond will mature and you get your principal back.
And what would be, when you say long duration, what would be too long of a duration in the fixed income world right now?
I mean, anything more than a couple of years. I mean, short. You want to stay really short and high quality, in my opinion. So if you look at what's happened in the bond market, last year bonds were negative, I believe, for the year. I know they're negative this year. In a rising interest rate environment, bond prices will go down. So as rates go up, prices go down. And if you own bonds, and a lot of people own bonds, why? They want to be safe. They want to protect their investment. And guess what? If you own long dated bonds, long maturity bonds, though the value of those bonds are going down.
And intermediate too.
And intermediate.
You're talking 4 years plus.
Well, even short term bonds, but they don't. The pain in those bonds are less. But all bonds really are losing value in this environment.
And here's, and I'm going to try to stay off my soapbox of the perception that bonds are safe. When you've got a 7.48% inflation, if wherever your money is, if they're not talking about this like we are right now, they're doing you a disservice. Because at 7.48% inflation, none of those bonds are making money. They're all riskier than owning the S&P 500.
Yeah, and I don't think, hopefully people understand that a rational investor is going to look at a bond today. I mean, a rational investor can't look at a bond today and say that's a good investment. You just can't. There's no way.
No.
You got inflation at 7.4%. Even if inflation was at, say 3%, it's still not a good investment. Yep. So why do you buy bonds? Why would you buy bonds? Well, the only reason you're going to buy a bond,
psychological fear.
Well, that, and maybe it's for liquidity reasons. You might have some liquidity events. Maybe you're retired and you need money that's more stable, and that's really the reason. I mean, Buffett's always talked about, he puts a lot of the cash reserves at Berkshire Hathaway into U.S. Treasury, short-term Treasury bonds, Treasury bills for the most part. And it's not because he likes it. That's just a place to park his money.
Yep.
That's all it is. But over the long term, it's a sure way of eroding purchasing power and the value.
Which is the biggest risk for people in retirement, is the eroding of purchasing power. I mean, that's the biggest risk.
Especially if
running out of money.
Especially if you're an investor that's trying to build wealth for future retirement. Bonds just make absolutely no sense.
So here's a question for you. We talk about our portfolio. We have right around 15 companies that we own. And a couple questions have come in from clients about, not just the allocation of what we're buying, but the allocation of how many businesses we own. And there's this great quote by Joel Greenblatt, a famous investor, and he said this, and then I want you to comment on it, Brian. We've talked about this many times, so have at it. He says, there is no sense diluting your best ideas or favorite situations by continuing to work your way down a list of attractive opportunities. What does that mean as we build a portfolio with 15 businesses?
Yeah, you really want to focus your money, your investments on your best ideas. And it doesn't, in my mind, it doesn't make any sense to give some of your best ideas on your 50th favorite idea. It just doesn't make any sense. There's 50 good ideas out there, and I'm going to rank them, and I like this company the best, and I really, really like it, and I'm going to allocate, a certain percentage of my portfolio into that great idea, incredible idea, great business, good value, great management, all those things. Then you get down the list of your 50th idea. Well, yeah, I kind of like this one, and how much should I put in that? Well, you probably shouldn't put anything in it. Zero. Put it on. Focus your best ideas. The money on your best ideas. Now, let me say that's not for everybody. Not everybody. And let me explain, because I think you're already disagreeing. Where's he going with it?
I am disagreeing.
Listen, if you don't know what you're doing, then what you should do is to buy not 50 but probably 500.
So here's what Warren Buffett said, and I pulled a Warren Buffett quote just for you today, bro.
Good.
He said, "Risk comes from not knowing what you're doing."
Yeah, if you don't know how to value a business, if you don't know how to evaluate a business or what's a good business, or you don't have the inclination or desire to do that, then you shouldn't be putting your money into 10 stocks. You shouldn't even do it in 20 or even 50. You should be calling us to do it for you. That's where you hire somebody you trust that knows what they're doing. And the reason we know what we're doing, it's not, oh gosh, we're smarter than everybody else. It's because we've devoted our careers to this I've been, for over 30 years.
Yep.
You're the same. Unless you have time to really dig in and understand a business and want to do that, have a desire to do it, then you should either hire somebody to do it for you or buy a low-cost index fund. That's really what you should do.
Yeah, and and as far as risk goes, risk on the other side of what Warren Buffett was saying, risk is mitigated by understanding what you're buying and understanding the risk associated with that business. So that if you put 10% of your money in it, okay, you know the risk associated with doing that.
Right. A lot of people ask, there's this old, I guess, a terminology or idea that the riskier the investment, the greater return potential. And I hate it. I hate that idea. I think it's stupid, actually. Being real blunt here.
Katie put a quarter in you. I like this. I like this, Brian.
We don't want to risk our money. And so we're trying to buy the least risky, best businesses that we know. We're not speculating. We're not like, hey, we're buying this particular company and saying, well, it's a coin toss. It's a 50-50 coin toss. This is going to be a good investment. And that's absolutely not what we're doing. But I think a lot of people think, higher risk, the higher return potential. Well, guess what? It's like a cliff. It's like, yeah, there's maybe some risk, but then when you get beyond a certain point, it's like there's a big cliff and there's a huge amount of risk, and we're just not interested in those kind of investments. We saw that in the very first part of this podcast. We talked about that with the risky investments that people took last year that are getting annihilated this year. Yeah.
Talk about that same thing. And you can't even protect it with stop losses.
Very, very risky. And
so
a lot of the risk there was the valuation on those businesses was just so risky.
Which again, risk comes from not knowing what you're doing.
Yeah, if you don't know how to value business or evaluate a good, what determines one good business versus another one, then you shouldn't be doing it.
I actually think that 15 companies in a portfolio.
It's too much.
It's too much.
You and Charlie Munger. I heard Munger say about 6.
Yeah.
But when you think about it.
But when you know what you're doing it's a business you're buying, right?
Right. Yeah. If you think about it, if you own 6 privately owned businesses, let's say you own Amazon and Apple and whatever,
Union Pacific, Wells Fargo,
Hershey's,
Bank of America,
Hershey's. if you own those, and they were all privately owned businesses, you own 6 of them, and you and I were having a conversation about that, I'd say, wow, that guy's got some great business, very diversified, and got some great businesses. But because they're publicly traded and you can trade easily, push a button in and out, and you get a feedback from the market every day what it's worth.
Yeah.
People think you got to own 100 or 500 stock, and that just doesn't make any sense. And I know that all the academics around the world, and I know you agree with this, would disagree with this on that.
Yep.
We strongly disagree with them.
Yep. That's all I'm going to say about academics right now. We could have a 4-hour podcast on that specific thing, but we're not. We're going to end this podcast today by saying this: the best way to fight inflation and a market correction is to own the best businesses in the world and to know that those corrections are going to come. And it's just part of owning public businesses. It's just part of the game. With that, it's also maybe the less you own as far as businesses go, but the more you know about them and the details behind the business and the nitty gritty, the less risk you actually have because you know what you're doing.
Yeah, and you know how to identify a great business. I mean, that's really what it all boils down to.
Yeah.
Identifying great businesses, and then also being able to, understand the value of that business, and because that's part of the equation.
So people that are at home nervous about the market right now, scared, they can't open their computers, what would you tell them? Last piece of advice.
They shouldn't be worried. They shouldn't be worried about the day-to-day fluctuations in the market. They really shouldn't. They should really think about, okay, yeah, the market might go down tomorrow. It might go down 3, 4, 5%. Who knows? I mean, we don't know. It could. But what I would say is, and I would tell them, and I tell myself this all the time, 3 years from now, I think probability that stocks are higher is pretty high. 5 years, even higher. I mean, even higher probability. 10 years, even higher probability. And that's really what, I mean, if your time horizon's less than 3 years, then you probably, that's really borderline whether you should be in stock and be investing in anyway.
That's the short-term bonds you talked about.
You might want to be in not even the short-term bond. You might want to just be in cash and the bank, and so if for long-term investors with 3 years, 5 years, 10 years longer, you shouldn't really worry about the ups and downs. And that's easy to say and harder to do. I totally get it because I'm an investor too, just like all of you. And I know that when the market was down 37% in 2020 over a short period of time, that was kind of scary. What's going on here?
But the scariest times provide the best opportunities, which is what we've been trying to capitalize on for our clients.
Yeah.
And we have made some adjustments in that regard to capture the opportunities because they're too good not to take. And
guess what? We make mistakes from time to time, and everybody does, even Buffett. I mean, everybody makes mistakes from time to time. You're never going to bat 1,000. But that's why we do have some diversity in our portfolio because, sometimes we make a mistake, but we feel like if we follow our processes and our principles, investment principles, we feel like we'll have pretty good success. And
amen.
We totally
it's being disciplined to the process.
Right.
All right, Brian, good conversation today.
All right.
Hope everyone found it useful at home. Relax in this market correction. Spring feels like it's springing.
It feels like spring.
Go enjoy the sunshine, get some vitamin D. Until next time, bye-bye.